Meta Platforms, better known as Facebook, reported earnings last night, and investors are very happy. It's off to the races with the stock up over 7% as of the time of this recording. So what did the company report during the quarter? Let's take the next 10 minutes to find that out. My name is Brian Stoffel. At the time of this recording, I do not own shares of Meta Platforms. And I want to give a shout out to Y-Charts for sponsoring today's video. More from them in just a second. So this was the second quarter of 2023 for Meta, ending in June. And after today's pop, it is about a $820 billion company. On the top line, revenue grew 11% to $32 billion. That was ahead of Wall Street's estimates and just $2 million short of the high end of management's guidance. Earnings per share jumped 21%. That beat Wall Street's estimates. Management doesn't give guidance there. Let's look at some of the big numbers that I like to look at. First, the daily active people. This is the number of people that every day use either Messenger, Facebook, Instagram, or WhatsApp. That actually showed a meaningful jump because look at this is 3 billion people. You can't expect that to grow by leaps and bounds anymore when you're at almost half of the world population. This is also really important. The average revenue per person went up on a year-over-year basis from $7.91 to $8.32. And if we look, it happened around the world. It went up in the US and Canada. It went up in Europe, significantly so. It went up in the Asia Pacific region, and it went up in the rest of the world. What does this mean? Basically, what this means is that the advertising market is making a little bit of a comeback. We've seen a lot of news coming out, whether it's US GDP growth or the inflation rate coming down to about 3%, that says maybe we're going to have a really soft landing here in terms of interest rates growing up, and recession isn't as much of a worry. When that happens, then companies feel free to expand their advertising budget again, and we're seeing that benefit Facebook right now. But it didn't stop there. If we look at gross margins, they contracted ever so slightly, but operating and net margins expanded. And in reality, they did even better than these show. We'll get to that in just a minute. Free cash flow absolutely ballooned to $11 billion for the quarter. Net income went up, and the balance sheet is in a phenomenal shape with about $60 billion in cash and about $20 billion in debt. Now, let's go down this income statement to see what I mean about this being actually better than the numbers tell. Because revenue was up 11%, and we said that those gross margins went down because the cost of revenue went up by more than that. That said, we're still talking about gross margins that are over 80%. Now, if we look at general and administrative, that went up 39%. That's a bit concerning. However, we need to keep in mind that there was a huge $1.87 billion charge for legal expenses. If we took that out, general and administrative would have been down 23%. And if we look at research and development, that went up by less, and we added marketing and sales, that went up far less than revenue did. If we add all that together, we see that income from operations was up 12%. Now, that's all right. That's better than revenue. However, if we also throw in with those legal expenses, $780 million in restructuring charges, boy, then that changes the story. If you add those things back in, income from operations through things that are not one-timey, that the company can control, we're actually up 44%. Let's just pause here and talk about this. Revenue is up 11%. Pretty good. Income from operations, if you take out these legal expenses and restructuring charges, we're up 44%. So takeaway number one from this earnings is that Mark Zuckerberg got religion over the last year about cutting the fat at his company, and he has shown that he is very serious about it. 11% revenue growth, 44% growth on income from operations. They have really become a lean operating machine right now. Now, continuing on, another thing that's worth noting is that the number of basic shares outstanding fell 5%. The company has been buying back a lot of shares. Now, let's then look at breaking down by where the company is getting its revenue from and where it's spending its money. Obviously, advertising is still the lion's share, but Reality Labs, this is the company's foray into the metaverse. It didn't bring in much, and it was actually far less than the same quarter a year ago. And look at this. Reality Labs is losing $3.7 billion this quarter on an income from operations basis. That's huge. And if you do some back of the envelope calculations, we're talking about a $16 to $20 billion run rate on spending on the metaverse. Now, that's takeaway number 2 from this is that Mark Zuckerberg cut the fat, but he is still very serious about doubling down on the metaverse. Will that work out? We don't know. We have to wait and see, but it's clear that they're very serious about it. And to really hammer that home, they said that they expect Reality Labs operating losses to increase year over year in 2023, and they expect operating losses to increase meaningfully year over year looking forward into 2024 due to ongoing product development of efforts in AR and VR. So look, the bottom line is this. Zuckerberg said, sure, I'm going to cut all the fat over here in this core business that we already know how to run really well, but I am very serious about investing in the metaverse. It's up to you whether or not you think that that's a good idea. Now, if turning towards guidance, this is another reason that Wall Street's probably very excited. The company guided for top line growth in the third quarter of 20%. That's significantly ahead of where Wall Street thought it would be. And look, this operating leverage is kicking in. Wall Street expects 78% growth when it comes to the bottom line. For the full year, no guidance given. These are Wall Street's estimates. Overall, what should you watch? I always say watch monthly and daily active users for the family of products, not because I expect a lot of growth, but if you see that number start pulling back significantly, that's a huge yellow/red flag. Second, average revenue per user. This right here is heading in the right direction, and that tells us the advertising market is coming back. Third, keep an eye on margins. Man, oh man, did the company show that they are serious about cutting the fat. But remember, Reality Labs will be dragging significantly on results. And fourth, keep an eye on free cash flow. All in all, I'm willing to say that I think the moat here is stable and slightly expanding. And I would say that the investment thesis is on track if you understand that you are willing to have Mark Zuckerberg spend so much on Reality Labs. If you don't like that, well then no, then the thesis is not still holding. Now, overall, I gave this score an 11.5 on my framework, but then we want to look at valuation. And so we say, well, where is this company in its growth cycle? And I'd say, given how much it's spending on buybacks, it's in stage 5. Given the operating leverage they've just experienced, you could argue stage 4. But so we look at things like price to earnings, price to free cash flow, forward earnings, shareholder yield. So now we can head on over to YCharts for that. Thanks again to YCharts for sponsoring. If you click on the link in the show notes below, you can start a free trial on YCharts, mention Brian Feroldi's name, and you get 20% off. This is a tool we use every day. So let's look. The company's PE ratio is 40 right now. You can see how much it's grown just over the past couple of months. That's expensive, but not exorbitantly so, especially when they expect top line growth of 20% and margins are expanding. It's also worth noting that part of the reason that this P ratio has gone up so much is because earnings per share has dipped as the two things have converged. One thing is the fact that pullback on advertising revenue. The other is that increased spending for Reality Labs. You could argue that that makes this somewhat artificially inflated, and for that, I think it's worth looking at the forward P ratio, which is a much more reasonable 27. If we look at the price to free cash flow ratio, it comes in at 49 before today. If you factor in the information that YCharts hasn't gotten to digest quite yet, it's actually just a 34. So that's, again, not cheap, but not exorbitantly expensive either. And then I love this feature on YCharts, which is the shareholder yield, which basically means how much are you getting in terms of debt pay down, in terms of dividends, but also share buybacks. Now, while it's not as high as it was in the past, about a 5% yield is still awfully good for a company like Meta. There is another way that we can measure this, and that is using a reverse discounted cash flow model. And for that, all we have to do is head on over here, type in our ticker symbol, after today's earnings, the company has generated $24.1 billion in free cash flow over the past 12 months. We have to set our terminal growth rate. I set it at 2% here. We have to set a discount rate. To me, Facebook/Meta is right in the middle of the road, so I'll give it a 10% discount rate. And then I just have to make these two numbers match. And we have to figure out where does it need to be for that to happen. I would say it looks like it needs to be at about 16, maybe about 15%, maybe about 15.5% growth of free cash flow every year moving forward for the next 10 years. Is that reasonable? Is it not reasonable? Overall, that seems pretty reasonable to me because the company is still spending a lot on Reality Labs, and those free cash flow margins can actually expand significantly. Remember, this is a company that had $40 billion in free cash flow during the pandemic, and I could see it easily getting back to a free cash flow yield that might not quite be what it was back then, but certainly better than it is today. So reaching that number, they don't even need top line growth of 15% per year because those free cash flow yields, those free cash flow margins can expand moving forward. So all in all, I actually think that this is a very reasonable valuation. I think it's more reasonable than the numbers might be telling if you just look at the price to free cash flow or the price to earnings ratio. So overall, I would even then go back and adjust my ratings to say that this is a pretty attractive valuation, and you could even bump this up to a 12. Not a stock that I own because, again, it is not, I'm not someone who invests in social media, but that is still very interesting to me. Now, all of this work about valuation is really important, and I want to mention that Brian Feroldi and I we've just opened enrollment to our last session of Valuation Explained Simply that we will be offering in 2023. Starts on August 7th, and in it we're going to talk about things like the business growth cycle, total addressable market, multiples, and then some of these tools that we talked about today, discounted cash flow, reverse discounted cash flow analysis. Important to also notice that this will be a nighttime class from 8 to 9:30 p.m. Eastern time on Mondays and Wednesdays. We'll also have office hours for this 3-week course. If you are interested in signing up for this, click the show notes in the link below. If you use the code BB, that's Brian and Brian, friend 249, you'll get a $249 credit for the course. But this course, that code does expire on Sunday, July 30th. So make sure you get a chance to do that. All in all, I think that Facebook is very reasonably valued today. In fact, I think if you suss out all of the one-time charges and consider the fact that the spending on Reality Labs is a drag on things, you're getting the core business for a very fair price, and this Reality Labs is almost like a really expensive insurance policy. It might work out, it might not, but they could pull the plug on that today and it would actually be just fine. In fact, I think it would be significantly more profitable and the stock would go up. They're investing in that for the long run. We'll see how that turns out. But all in all, this is a really positive quarter for the company. We'll check back in on Meta Platforms in 90 days. Let me know what I missed in the comments below. Until then, Brian, out.